Cash flow statement lecture 1. Cash flow statement is prepared as per the format given under Accounting Standard 3. For the purpose of assessing cash flow of a business, all the activities of a business are divided into three major categories: operating, investing, and financing. The sum total of all three activities is regarded as cash inflow or outflow of a business. For today's lecture, we are going to learn how to calculate cash flow from operating activity. To calculate cash flow from operating activity, we begin with working notes where we calculate net profit before tax and extraordinary item. For that, we begin with net profit after tax and extraordinary items. This we get from the difference in the statement of P&L account. To this we add four things: proposed dividend, that is for previous year, interim dividend, this will be given in the additional information, provision for tax current year, and transfer to reserves. And we deduct one thing: refund of tax. Extraordinary items, if any debited, are also added, and extraordinary item, if already credited, are deducted besides the things written here. From all this we get net profit before tax and extraordinary items, which will be our beginning point for calculating cash flow from operating activity. Please remember, from A after we go to B before. Alright. From here we are going to begin with our cash flow statement for the year ended, and we are going to begin only with cash flow from operating activity, which begins with net profit before tax and extraordinary items, which you write here. All the calculations are done here. The final answer from operating activity will be calculated in the outer column. To this, now this first step over here is we will adjust for non-operating and non-cash items. All the non-operating expenses which were and non-cash expenses which were deducted earlier will be added back, and all non-operating and non-cash incomes, although there is no non-cash income, which were added earlier will now be deducted. So we will add all. There are only two non-cash expenses, that is depreciation and amortization. Then any non-operating income like non-operating expense like interest on debentures or long-term borrowing which is given, that is also deducted. Then loss on sale of asset. Then if anything is written off, like write-off of preliminary expenses, underwriting commission, issue share expenses of shares, anything which is written off is deducted. Along with interest on debenture long term borrowing, we also take interest on bank overdraft. All this is added. Along with this, any increase in provision for doubtful debt, all this is added. We deduct any non-operating income can be in the form of interest, dividend, rent. Any non-operating income which was received will now be deducted. There can be no non-cash income. Then if loss was added, then the gain on sale of asset will be deducted. Gain on sale of asset. And if increase in provision was added, then decrease in provision for doubtful debt will be deducted. From this we will get net profit before working capital. From all this we get net profit before working capital changes. Now we will begin with step 2. Step 2 is adjust for working capital changes. You will add any decrease in current asset and increase in current liability, and you will deduct any increase in current asset and decrease in current liability. The easiest way to remember that is जब दोनों arrow का मुंह उनके एक दूसरे की तरफ है, friendship हो गई, so this will increase. If they fight, then they decrease. This will give you net profit after working capital changes. From this you will deduct income tax paid. This will give you cash flow from operating activity, which you will get here after all the calculations in this column, and you will carry it in the outer column. This is how we get cash flow from operating activity. Thank you.